Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Ticker symbol XXI, 21 Capital. As we sit here looking at the tape Friday morning, February 27th, 2026, the price is hovering right around $6.14. Earlier this month, we ground out a fresh 52-week low of $5.74. And I mean, it is ugly out there on the surface.
It's historically ugly.
It is. But if you stop staring at the red ink on the daily chart and actually look at the plumbing underneath, the actual flow of capital, the data is telling a completely different story. We are seeing massive, and I mean massive, volume anomalies. I'm talking about block prints, where off-exchange volume is consistently exceeding 60, sometimes 70% of the total daily trading activity. On February 20th alone, the off-exchange short volume ratio hit 73.63%.
Right, but okay, hold on. You look at those numbers, 73% short volume, these massive off-exchange prints, and you see a volume anomaly or some kind of hidden bullish accumulation signal. The rest of the market looks at that chart, specifically that 71% drop below the 200-day moving average, and sees a structurally broken equity.
Broken in the short term, maybe.
Broken fundamentally. In technical analysis terms, this is currently flagged as a sucker stock. We're not talking about a healthy correction here. We are talking about a company that expressed literal going concern doubts in its late 2025 filings, and now it's trading entirely at the whims of a very specific and, frankly, very controversial coalition of crypto insiders.
I get why you'd frame it that way if you're looking purely at the chart damage and maybe the headlines. I'm not denying the trend is down. It has been absolutely brutal for retail. But the central question we are debating today isn't just, is the chart ugly? We know it is. The question is, are we looking at a fundamental dislocation between price and value?
I would argue there is no dislocation. The market is pricing it exactly as it should be priced.
I disagree completely. The market is pricing this like a distressed SPAC blowout, like a company on its deathbed. But the smart money, the institutional players, they see the third largest corporate holder of Bitcoin in the world, trading at a deep, deep discount. So I am taking the institutional bull case today. To me, this isn't a broken company. It's a misunderstood asset in the middle of a massive handover from weak retail hands to institutional giants. It's a watershed moment for Bitcoin adoption.
And I will be taking the structural skeptic position because I don't see an institutional bridge at all. I see a leverage play with a dangerous ownership concentration that is currently being dumped, really, onto retail investors under the guise of accumulation. You see a discount, I see a structural trap.
Let's start right there with the valuation argument because it's the anchor for my entire thesis. If you ignore the noise, you have to look at the math. The current price of $6.14 represents a massive market inefficiency. By our calculations, we are trading at roughly a 12% discount to the market net asset value, specifically the spot Bitcoin holdings on their balance sheet.
Just to be absolutely clear for anyone not tracking the NAV arbitrage daily, you're saying if we liquidated the company today, sold every single Bitcoin, paid off the complex debts, shareholders would actually get more than the current stock price?
Exactly. If you closed 21 Capital today, liquidated the treasury, paid off the convertible notes, shareholders would likely see a return closer to $7 a share. You are effectively buying pristine collateral, Bitcoin, for 88 cents on the dollar. That is a textbook arbitrage opportunity. But the real signal here isn't just the math of the discount. It's who is stepping in to buy that discount.
You're referring to the SoftBank filings.
I am. And this is the part people are missing because they're too zoomed in on the daily volatility. In the fourth quarter of 2025, SoftBank Group, specifically through their vehicle Stellar Beacon LLC, made a definitive aggressive move. They liquidated multi-billion-dollar positions in NVIDIA to acquire 89.1 million shares of 21 Capital.
Right.
That stake is valued at roughly $780 million.
It's a huge bet, I'll grant you that. $780 million is real money, even for SoftBank.
It's more than just a bet, though. Think about the macro implications of that rotation. They sold the ultimate pick and shovel play of the AI boom, NVIDIA, the absolute darling of the last 3 years, to buy the treasury play of the digital asset economy. This signals a massive strategic shift. They are moving from AI hardware to digital asset treasury as the primary growth driver for the next decade. SoftBank is essentially saying, we've made our money in chips, the hypergrowth there is over, now we're parking capital in sound money.
It signals a shift into something, certainly, but my question is, a shift into what exactly? Because SoftBank has a long, documented history of chasing trends at the absolute top. Remember WeWork? Remember some of those disastrous vision fund bets? Just because Masayoshi Son buys a narrative doesn't mean the underlying vehicle is structurally safe.
But it's a shift into a vehicle where the Bitcoin per share metric is the literal North Star of the company. Look at the compensation package for their CFO, Stephen Mahon. This is crucial for understanding the alignment here. His stock options aren't tied to traditional metrics, not earnings per share, not EBITDA, not USD revenue targets. They are tied to a specifically mandated 15% growth in Bitcoin per share. This ensures that management has only one incentive: accrete Bitcoin for the shareholder. 21 Capital isn't just a holding company. It's a nascent Bitcoin bank. They are building lending and capital markets advisory services to generate yield on that massive treasury.
Okay, that is a very compelling narrative. The idea of a Bitcoin bank sounds fantastic in a pitch deck, but I'm sorry, I just do not buy it yet. Let me tell you exactly why. You focus heavily on this Bitcoin per share target, but you are completely ignoring the dilutive reality of their capital structure that makes hitting that target mathematically grueling. You have to look at the February 12th, 2026 filing, the Form 424B3.
That's just a standard resale registration. Every former SPAC does that to clear the pipes.
It's standard, yes, but in this specific context, it's lethal to the price action. This is a registration for $464 million in convertible notes, plus 33.5 million underlying shares. These notes are held by early pipe investors, hedge funds like Armistice and Hudson Bay. These guys are sophisticated arbitrageurs. They are not long-term believers in your Bitcoin bank thesis.
They provided the bridge capital.
Bridge capital that comes with a massive toll. These notes allow them to convert their debt into stock at a Bitcoin reference price of around $84,000.
Which is essentially an at-the-money option right now, given where spot BTC is trading.
Exactly, and think about the market mechanics of that. This creates a massive structural ceiling on the stock price. Every single time the stock tries to rally, these note holders have a fiduciary incentive to convert the debt to shares and sell them directly into the market to lock in their spread. It acts like a dampener. It creates an endless wall of supply. And let's go back to that off-exchange short volume you championed in the intro. You call it liquidity provision, I call it opaque, relentless selling pressure. When the short volume ratio hits 74% in dark pools, that is not a bullish accumulation signal. That is the sound of early investors exiting into retail liquidity.
Okay, let's stop right there and actually dig into the dark pools, because I think this is where the average investor gets the most confused and, frankly, where I think your interpretation of the mechanics is slightly off base.
Walk me through it then. Why is 74% short volume somehow good news for a stock at a 52-week low?
You're citing that February 20th short volume of 73.63% as undeniable evidence of a dump. But in modern equity markets, especially for high-velocity, institutionally targeted assets, high short volume in dark pools is frequently a bullish signal of accumulation, not distribution.
Explain the logic there, because to anyone listening, short volume sounds exactly like people betting the stock goes down.
It does sound like that, but that's a fundamental misconception regarding how market making actually functions at scale. When an entity the size of SoftBank wants to buy 89 million shares, they do not go to the open exchange on the NYSE and click buy. If they did, they'd spike the price instantly, they get a terrible fill and move the market violently against themselves.
Sure, they go to a dark pool to hide the size of the order. That's standard block trading.
Right. They go to an institutional market maker, firms like Citadel Securities or Virtue Financial. The market maker agrees to sell SoftBank the shares at a negotiated set price.
But here is the key mechanical step. The market maker doesn't actually have 89 million shares sitting in their back pocket. So, to facilitate that trade immediately, the market maker technically shorts the stock to SoftBank. They sell what they don't have to fill the client's massive order.
Right, creating a synthetic short.
Exactly. Then, throughout the day or even over several days, that market maker goes out into the broader market and buys shares to cover that short position. So that massive spike in short volume, it's not bearish hedge funds betting the company will fail. It's the literal footprint of a whale buying, and the market maker providing the liquidity to make it happen smoothly.
That is the textbook definition of market making. Yes, I understand the plumbing, and if the price was holding steady or slowly climbing, I might actually agree with you that it was pure facilitation for SoftBank. But look at the price action accompanying that volume. The stock hit a low of $5.74. If this was purely accumulation by diamond-handed institutions, we would expect to see price support. We'd see a floor. Instead, we saw a free fall. Those volume clusters we saw in mid-December and again in February look much more like the market violently digesting a new capital structure, not smoothly onboarding a whale.
But we are seeing that support right now. The $6 level is holding firm today. The bleeding has stopped.
Barely holding. Look, you have Cantor Fitzgerald acting as the architect here, and they are brilliant at moving paper, no doubt. But I would argue they are facilitating exits for the SPAC arbitrageurs. The folks who bought the shell company originally, not the fundamental Bitcoin thesis. They want out of this volatility, and Cantor's finding them a door.
Cantor is the architect, yes, but I view their heavy involvement as a major feature, not a bug. They are providing the sophisticated plumbing required to move billions of dollars of Bitcoin exposure into institutional hands without spiking the spot price of Bitcoin itself. That is incredibly hard to do. The stabilization we are seeing near the $6 mark right now suggests that the dump, or the rotation, as I prefer to call it, is finally concluding. The weak hands from the SPAC era are out. The long-term treasury holders, the SoftBanks of the world, are in.
I'm just not convinced by that line of reasoning because it willfully ignores the counterparty risk. Let's pivot to the coalition actually running this ship. You have Tether and Bitfinex with absolute voting control over the entity. SoftBank is now the second largest holder, sure. You called it a watershed moment. I call it a terrifying concentration of risk.
Why is it a risk? It's a concentration of deep expertise. Having Tether and Bitfinex backing the firm ensures 21 Capital has access to the deepest liquidity pools in the entire crypto ecosystem. This completely differentiates XXI from a company like MicroStrategy.
How so? They both just hold coins on a balance sheet.
MicroStrategy is a legacy software company with a Bitcoin treasury. They buy Bitcoin and they hold it in cold storage. They are entirely passive in that sense. 21 Capital is fundamentally Bitcoin native. It is integrated directly with the very infrastructure of the industry. Tether practically is the liquidity of the offshore crypto market. Being a subsidiary of that ecosystem gives 21 Capital advantages in lending and yield generation that a traditional software company simply cannot replicate.
But that integration is exactly the problem. We know that regulatory scrutiny on stablecoins, specifically offshore stablecoins, is heating up rapidly. If Tether faces any sort of serious regulatory action or even just a significant audit challenge from the US government, 21 Capital is sitting directly in the epicenter of the blast radius. Tether holds 51.3% of the voting power alone.
That is a fair point on the voting structure. It is highly concentrated.
It's more than fair. It's critical for any investor to understand. Minority shareholders, the public, have zero say in governance. The board of directors is essentially an extension of the Tether and Bitfinex executive team. If they decide to pivot the strategy overnight, or worse, if they need to liquidate assets to cover issues elsewhere in their offshore empire, the public shareholder is totally helpless. You are buying a passenger ticket on a plane where the pilot might have to eject to save himself and you don't even have a parachute.
That is a theoretical tail risk, sure. But every holding company has governance risks. Look at the real-world validation, though. SoftBank didn't enter this blindly. They have massive teams of lawyers, auditors, and analysts. They did their due diligence and decided to put nearly $800 million into this specific vehicle. They could have just bought MicroStrategy. They could have bought the spot ETFs. But they chose 21 Capital. Why? Because they validate the model of a Bitcoin-native financial services firm.
Or, conversely, they see it as a distressed asset they could pick up for pennies on the dollar relative to its potential upside. Let's not pretend SoftBank's track record is spotless when it comes to risk management. They love a charismatic founder and a grand vision, and they will often back it at the expense of basic unit economics. They are risk-on momentum investors.
They've had misses, obviously, but they also nailed Alibaba. They nailed ARM. When they get a structural trend right, they get it generationally right.
True. But let's look at the actual financials driving this vehicle. We are talking about financial engineering versus actual business viability. The predecessor entity had a net loss of $656,000. Now that's negligible in the grand scheme, sure. But the going concern doubts formally raised in late 2025 are not negligible. This company relies entirely on issuing new debt to buy volatile assets.
You're talking about the 1% convertible senior notes due 2030.
I am. 1% interest. It sounds great, right? Incredibly cheap money. But it introduces those complex dilution dynamics we talked about. They are borrowing massive sums of money to buy an asset that is historically prone to 70% drawdowns. If Bitcoin enters a prolonged winter, a multi-year crypto winter, they still have to service that debt. Without a genuinely generating operating business, without real USD revenue from this Bitcoin bank concept, they are just a zombie fund bleeding capital to stay alive.
I have to push back hard on the zombie characterization. That 1% interest rate is a badge of honor in corporate finance. In a relatively high interest rate environment, borrowing capital at 1% is practically free money. It shows that the credit markets view the 16,000 plus Bitcoin collateral as absolutely pristine. This is their accretion strategy in a nutshell. Borrow fiat at 1% to hold a hard asset that has historically appreciated at a significantly higher annualized rate. It's a simple, elegant arbitrage.
Arbitrage works beautifully right up until the moment it doesn't. If the collateral asset drops severely, you're underwater on the debt.
But there are major de-risking events on the immediate horizon that change that math. The CFO's incentive plan explicitly requires a full, transparent public audit and the implementation of institutional safety protocols. Once those audits hit the tape, the institutional discount, the entire reason we are trading at $6 instead of NAV at $7.50, will vanish. The stock will naturally re-rate to match its holdings. And we also have to mention the broader sector competition. Blockstream is coming to the public markets via their own SPAC.
Right. Blockstream, that is the other elephant in the room for this trade.
The whole sector is heating up. 21 Capital has the absolute first-mover advantage on the New York Stock Exchange with a $4 billion treasury. When Blockstream lists, it will likely trade at a massive premium because the market views them as pure-play tech company. That valuation will inevitably pull 21 Capital up with it as institutional investors look for the relative value play in the sector. A rising tide lifts all boats.
See, I view the Blockstream comparison very differently. Blockstream is a real company with real proprietary technology. The liquid network, mining hardware, satellite infrastructure, they build tangible things. 21 Capital, right now, is essentially just a leveraged treasury with a promise attached. You mentioned the lending and education businesses earlier. Where's the actual revenue? Until they prove they can generate consistent, non-crypto revenue to service that convertible debt, the Bitcoin per share metric is just a clever distraction from the fact that they are burning fiat cash to keep the lights on.
The revenue will come from the yield on the treasury and the advisory services. They are actively building out lending facilities that completely bypass traditional banking hurdles. In a world where legacy banks are utterly terrified of touching crypto collateral, 21 Capital becomes the lender of last resort, and really the lender of first choice for the entire industry. That is an incredibly high-margin business.
It's also an incredibly high-risk business. Lending against crypto collateral is exactly what blew up half the industry in 2022. Celsius, BlockFi, Voyager, they all thought they had a high-margin business lending against coins, right up until the collateral value evaporated and the margin calls failed.
But 21 Capital is doing it with the backing of the most liquid entities in the space. They aren't rehypothecating retail client funds to chase yield. They are leveraging their own over-collateralized treasury. It's a fundamentally different and much safer risk model.
We will see if the broader market agrees with that assessment. Right now, the resale registration heavily suggests that the smart money that funded the initial PIPE is actively looking for the door, or at the very least, a wide window to hedge their exposure. They want the option to get out.
Let's pull back and look at the big picture as we wrap this up. I look at that chart and I see the ugly price action. Yes, I acknowledge the retail fear. But I also see a mathematically verifiable 12% discount to spot Bitcoin. I see SoftBank aggressively switching from NVIDIA to 21 Capital. I see a management team whose compensation is incentivized strictly on Bitcoin accretion. This is a rare dislocation opportunity. The current discount to NAV is a temporary gift caused by standard SPAC churn and structural misunderstandings. They are building the infrastructure for a Bitcoin standard financial system, and the market is currently pricing it like a failed software startup. That gap will close.
And I look at that exact same chart and see a stock trading dangerously below its 200-day moving average, burdened with massive structural overhead. You have the tether control risk, which is completely unquantifiable for a retail investor. You have the convertible note overhang sitting at $464 million, waiting to dilute rallies, and you have a business model that simply hasn't proven it can generate sustainable cash flow. While the macro Bitcoin thesis might be perfectly sound, the vehicle itself, 21 Capital, carries entirely unnecessary baggage. Why take on the regulatory blast radius of Tether and the dilution risk of Wall Street arbitrageurs when you could just buy spot Bitcoin? Until these volume bursts settle down and management proves the business model works, this remains, in my view, a highly speculative play that is dangerously close to being a permanent sucker stock.
It seems we are at a fundamental stalemate on the viability of the vehicle itself, even if we agree on the asset class. But I think we can both agree on one thing. The upcoming public audit and the Blockstream listing will be the decisive catalysts.
Absolutely. If Blockstream lists and immediately trades at a premium while 21 Capital stays stuck at a discount, the market will have spoken very clearly on the quality of the governance.
And if 21 Capital successfully closes that audit and continues to accumulate aggressively alongside SoftBank, that discount window will slam shut very quickly.
Time and the tape will tell.
We will be watching the tape.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.